Welcome back. Let's talk to Federico Bentley. He's a sales trader at Ayondo. Freddie, Happy New Year.
Happy New Year, thank you.
Right, you've got 7 slides for us to go through. Before we kick off, right, can we just give me the headlines on Ayondo, anyone watching this for the first time? Now, this is social trading.
Yeah, so we offer sort of two sides to trading. You've got the social trading, very similar to managed funds, where you can simply follow particular traders, you analyse their performance, scrutinise them, and once you follow them, everything's emulated one-to-one. So that's sort of the social side. And then you've got the other side, which is just your own trading. And with Ayondo, the benefits you really are getting is you have a lot of sort of insurance policies, and you've got that zero balance protection, so you can never go into negative debt. With a lot of brokers, you do have that potential of going into negative debt if there's a big movement against you. So with Ayondo, you're getting the full protection alongside lots of sort of customizable sort of assets on the platform. You can increase the margin one-to-one, so if you don't want to trade a margin and just hold a stock for 1-2 years, you can simply do that, and you're paying no financing.
Yep.
So there's sort of I guess, a variety of things that you can do on the platform.
Well, I think the important thing is people go into trading and they think this is very straightforward, it's easy, they do the paper trading, the returns on capital employed are fantastic.
Yeah, exactly.
But there are periods when you're trading where it's very, very difficult.
It is tricky, especially when your strategy isn't working.
Yeah.
And that's when sometimes the social trading comes into play. A lot of the time, you might not have the time to trade yourself. So if you're still trading but you haven't got the time, you're not being very attentive. And that's when it can become risky. You're not putting your stop losses, you're not managing your risks. And that's when the social trading can sort of accommodate.
So if I copied you in simplest form, I'd pledge money into the account, and every trade you did, it would be replicated in my account.
Exactly, and you can sort of increase or decrease the risk factor. You put a sort of a stop loss on the overall account.
Right.
So you've got sort of 100,000 following DOWREX, and you don't want to risk more than, let's say, 10%. You simply put your loss protection at £90,000. So if the account does sort of diminish by £10,000, 10%, you simply sort of close out all the positions, so you're not risking more than roughly 10%. So there's lots of ways sort of around managing the risk, which is, for me, it's fundamental.
Understood. Okay, we've got 7 slides to go through. Let's kick off on the first one. DOWREX. What is this telling everybody?
Name. So this guy, in the last sort of 2 years, we've been looking at sort of DAX, FTSE traders, some equity traders. This guy is actually trading the Dow, hence the name. He's got a very low risk score of 2. Risk score 1, 10 being the highest. So 2's, it's definitely still within the low range.
And that's your own risk model, is it?
Yeah, that's your own risk factor risk score that looks at a few sort of maximum leverage ratio, current leverage ratio, historic leverage ratio, your maximum drawdown, unrealized losses, and your career level. And he's at level 4. So it looks at sort of a variety of things. Obviously this year, if you look at the US indices, Dow was up 26%, S&P 20%, NASDAQ was up 32%. So it's fairly modest. It's only about just shy of 12%. But it's with very low volatility, low drawdown, and I guess you're doing it under a spread bet, so you're not paying any capital gains.
Right.
Typically if you're holding, let's say in this example, the Dow, you probably would have done it as a future, as an option, but you still have to pay tax on that.
Right.
You may have got slightly better performance, but this guy over just shy of 2 years, it's returning about 10 to 15%. So it's within that range, and he's trading around 65 times a month. So it's fairly active, but it's more in and out. So you can see his chart there. Comparing it to the DAX, which is up about 12% this year. So it's sort of in line with that performance, but with pretty sustainable and low risk.
Understood. Okay, so let's go on to the next person, male or female, POSITIV.
POSITIV, yeah. So this is a German trader, I believe, and he's looking mostly at DAX. He's recently been trading a bit of Bitcoin, so obviously got some, I guess, nice tailwind out of that. Mostly been going long, so he's been doing fairly well. But he's mostly, mostly DAX. He's got a fair amount of track record in just over 2 years. Again, risk score of 1. When I look at any of these top traders, I normally look at a risk score of between 1 and 2, maybe 3 if you're looking for something a little bit more, I guess, eccentric. But if you look at the performance, it's just shy of 80% in 2 years. So it's pretty good performance, but the volatility and the maximum drawdown still sort of in line. He had earlier last year, sort of had a few bad months. July was probably his worst month, but since then it's been a very strong end to the year, up about 47%.
Wow.
He's trading not too often. It's only about 9 trades a month. So it's not too active, doesn't hold trades for very long, which I quite like. But still, very, very good performance. Much better than the DAX. DAX returned, 12% last year. He's returned, 48% almost.
Okay, so let's move on to open positions. What's this telling?
So you can see the open positions, there's only 2, so nothing too much. It's very small units.
And that's in real time, so any open positions on the system?
Exactly, you'll be able to see that this is real time. Transaction history is purely the old trades that he's closed out. you can see the unit sizes.
And is that mark to market at that point in terms of the NAV of
It
the
is,
individual?
exactly. So you can see the profit there. That's obviously going to be fluctuating on his open position. So you'll see that that's just, the unrealized position. But as unit size, that's just simply a stake size. So it's fairly in line. When you're looking at the risk score, it looks at the maximum leverage ratio and historic leverage ratio. You can see here it's fairly consistent. €2 point, €1 point, maybe below. If he's one day trading €1 point, the next day it's €100 point. There's a massive disparity, and that's going to increase that risk score. So it's good to see that it's consistent. Risk per trade sometimes a little bit high, about 3%, but that's purely because he's trading with fairly wide stop loss. So you can see he's trading the DAX at a price of 13,100, but his stop loss is at 9,700. So obviously it's a fairly wide stop loss. It's fairly unrealistic that's going to hit that, but if it does, at least you've got that stop loss. With all the top traders on the social side, you have to trade with the stop loss. So there is that risk that is being sort of managed.
So basically you can't put a trade on without putting the stop loss in.
Exactly. The maximum risk that you could potentially risk on one trade is 10%.
Right.
And obviously you can customize
and that's
that
a system default.
That is a system default. But if you wanted to sort of tone down that risk, and you saw that he's risking 10% on that trade, you can just jump in, move the stop loss to 2% away.
Right.
So that's what I mean why it's very customizable.
Okay, well, let's talk about somebody who's not perhaps doing it quite so well.
So this is
drawdown.
EDLEMETALLE. He used to be our most popular trader. I've been sort of warning the risks that he's bringing for the last year because he has a lot of open positions. At one point he had 150 trades open, which mostly on the DAX. If you're just long on the DAX with 150 positions, they might be very small sizes, but all it takes is a little drawdown of 300 points, 400 points, and it's going to massively exacerbate your account. So in my way, it sort of seems like he's almost hemorrhaging money because it's just not a very good strategy. Anyone can do it. And he's been doing obviously very well, but with so many open positions, you have that risk. We've had a drawdown November 2016, about 20%. Happened again over the summer, wasn't too great, but it happened again this last year, November, and he's finally exceeded that drawdown of 25%, up to 32%. So this type of strategy, I think, is fairly risky. Obviously, you've got the risk score 7 there, and it's been there for a while because it's looking at that maximum leverage ratio, historic leverage ratio, the unrealized losses, which have always been fairly large. A lot of the time he's running losses of 20% on the account, which obviously if you have enough in the account, it's fine, but it's for me, it's a massive worry. So in a way, it's good to see him that he hasn't got as many followers because it's a risk for me. So at one point he had just shy of 2,000 followers, so that's just all of the followers have just gone elsewhere, and hopefully following someone with a risk score much lower than 7.
Okay. Well, let's go on to remuneration. What is this all about?
So with him, obviously, he was at level 5, which means he's getting 12% of any revenues that
because he had that many followers.
Exactly. Okay. So obviously, the more followers you have, you're still getting 12%.
Right.
12% of 1,000 followers or 10,000 followers, obviously, you should be getting more from 10,000 followers. So now his incentive is almost gone because once you exceed that drawdown 25%, you get demoted down to level 1, and you can never exceed back to level 5.
Right.
So you can see he's back to street trader, and he's only getting 2%. So he's getting 10% less revenue or less.
So basically, at the level 5, you're taking 12% of the commission.
Pretty much
from those
exactly
clients.
From anything. Yes, anyone who follows you. Whatever their any revenue that they're paying, you're getting 12% of that commission almost. So now it's 2%. So there's no incentive anymore. So for me, it's if you're still following, that's quite a big risk. If you're still trading, but you've got not as much incentive, you might be taking more risk to get that performance back. So it's almost another one. If you're still following him, I think that's even more risk now because you might be putting on bigger trade sizes to get that performance back. Even though he can never go back to level 5, he might want to sort of prove his point by getting better performance.
Just a word on virtual money trader. What's that?
So VMT is someone who's actually trading on a demo account. We don't really have that many, but that's why you can see it's half as much. So I guess it's all about mentality. If you're a demo account, you're not risking your own cash. You might have better performance because you're going for those trades.
So you'd pay out on a dummy account?
Yeah, we'll have to, but we don't really have any. I mean, we have very few. Because the good thing is that you'll know that if a virtual money trader is a top trader, you'll know that he's trading with no money. So typically, you're not going to get any followers. I personally wouldn't follow someone with that. But if it's different psychology, they might have a better performance because they're not risking their own cash. So if you're looking to put X amount,
but that's not trading.
It's not trading. It's not trading. You know so at least you've got to know about.
Let's talk about investing. What's this?
So yes, obviously, as we mentioned in the beginning, we offer social trading, but you'll also offer sort of your own trading. So if you're looking to have a bit of sort of passive trading or just typical long-term equity trading, you can always do that with the sort of the margin rates that we have. Typically, if you look at a stock, might have 5 to 10% margin, so you're still borrowing 90%, right? But if you wanted to increase the variable margin to 100%, you're not borrowing any money, so there's no financing costs.
Right.
So there's no difference to doing it with us than it is doing it with a bank.
Okay.
The main difference really is that because it's still falling under a spread bet, you're not paying any capital gains. So if you're a higher taxpayer, you've got to pay 20% capital gains. After the first
So
7,300.
you're funding the position outright. You're taking
Pretty
it
much.
with you.
Yeah, exactly.
Okay.
A lot of people might use us to hedge their positions elsewhere. They're
Right.
doing it with their bank or through through their stockbroker. But the beauty is we've got plenty of ETFs on offer. SPDR. Biotech, looking at about 105 stocks in the S&P 500. Obviously, mostly biotech, but since inception in 2006, it's returned about 20% a year. So you can sort of hedge yourself in various ways.
Right.
Especially if you're just looking to buy Apple and you just want to hold it for 5 years, or if you want to trade, if you can afford it, or Bitcoin, for example, if it's gone down to let's say 10,000 or whatever. You just want to hold it, you can do that with 100% margin.
Right.
So at least you leave it there, you won't be on a margin call, you're not paying any financing, and if you make 20 grand, you're not paying any tax on that. So that's one advantage that Ayondo does have, is that variable margin that not many brokers offer unless you're doing it through your bank, and then obviously you have monthly costs.
Yep.
So it does add up.
Well, let's wrap up with the bonus scheme. The January bonus, what's this all about?
Yeah, so we sort of had a sort of a bonus last Christmas that was around for about a month, and we sort of extended it, I guess, till the end of this month. And it's only pretty much 25% on anything above sort of 2,000 to 100,000. You can get a 25% bonus. Obviously, it's not free money. The way it works is to say hypothetically on a 100,000 deposit, you'll get £25,000. Once you've generated £50,000 in spread, so twice the amount of bonus, that bonus is yours. It's your cash. You can do whatever you want with it. There's no time expiry, which is nice. A lot of other brokers, ETX, they used to give you sort of a 90-day period, and that's sort of rushing your trading. So the good thing is not having a time sort of expiry, because it's just rushing your trading, and that isn't really trading.
Right. So if I put £100,000 into the account, I've got to do a number of trades, have I, basically, to take the bonus?
Exactly. It's not necessarily a number of trades, because obviously it depends on the stake size. Because if you're trading £100 a point on the FTSE, that's 1 point spread. If it's £1 a point, obviously you're only charging £1. So it depends on the size of the trading.
Okay.
But yeah, technically it's purely double the amount of bonus that we've given you.
Right.
And spread, then the bonus is yours.
Okay.
Any
the full
profits,
terms are on the website, right?
Yeah, exactly. Full terms are there. And any profits you make, you can withdraw without affecting the bonus. So it's fairly simplistic.
Okay, all sounds very interesting.
Yeah.
Final thoughts, 2018?
That's it. Watch the cryptos, I think.
Yeah.
I think the big ones might be overtaken by the smaller ones, the smaller coins. And gold, I think, is still a good one to see. Last year was up, 14%? Best run since 2011. So it'll be interesting to see how it sort of carries on, especially in such a overpriced and overvalued market, I believe.
Brilliant stuff.
Thank you.
Thank you.